317 retirement withdrawal strategies. This is so important. Obviously, if you're listening to this podcast today, you probably have retirement on the horizon and you're wondering if you've saved enough to be able to retire and to be able to maintain the same standard of living that you've grown accustomed to. And you don't want to have to worry about running out of money in retirement. And that's what we've been teaching people about for the last 10 plus years on Sound Retirement Radio. But in order to do this, in order to make this transition into retirement, you're going to need to decide on an investment portfolio withdrawal strategy. And in today's show, I want to give you a high-level overview of 7 different strategies for you to consider. And then what I'm going to do in the show notes is I'm going to include links to additional articles so that you can do a deep dive on the strategy that you'd like to research in more detail for your specific situation. And then, of course, at the end of this show, I'll share a little bit more about the strategy that we do and that we use for a lot of the people that we serve and why I like it and why it makes sense. And some of this is going to depend on just how much you've saved. Obviously, the more you've saved and the lower your spending is, the more flexibility we have in how we structure this for you. But before we start with the portfolio withdrawal strategies, there are 4 very important numbers that you'll want to understand before you make the decision to retire. I can't emphasize this enough. Now, of course, we have worked with people after they make the transition, and that's okay. And sometimes it works out, sometimes it doesn't. But it's always nice to be able to know this before you actually pull the plug. This is one of the biggest, most important financial decisions of your life. And so I highly recommend that you have a good plan before you decide to make the decision to retire. Here are the 4 things you really want to know. How much do you plan to spend? And not only how much do you plan to spend, but ideally, you want to be able to break down your spending between your essential and your discretionary expenses. The next part is, how much are you going to have from guaranteed income sources? So Social Security, pension, annuity income, money that's in some way guaranteed. So first is expenses, second is guaranteed income. The third number that you're going to want to understand is how much have you saved? So you're going to want to look at all of the different pots of money that you have out there. And it's always amazing to me, it always surprises me when I sit down with people and I ask them, well, how much does this all add up to? And a lot of people don't know that number. So look at your 401ks, your IRAs, your Roth, your TSP, your bank accounts, your money market accounts, just any place that you have money that's available for us to help supplement your income. Add all of those up. And then the 4th number is we have to have some idea about longevity. This whole thing, the big concern most people have is they just don't want to run out of money before they run out of life. And so we want to make sure that we have a really good income plan and that hopefully that income plan is going to be sustainable, not just for the first 10 years of retirement, but that you don't have to go back to work in retirement. I think that's what nobody wants to be 75 years old. I always hear people say, Jason, I don't want to be greeting people at Walmart at 75 years old. And of course, Walmart doesn't even offer greeting positions anymore. So anyways, once you're armed with the most important numbers, you're then going to need to decide on a strategy for taking withdrawals from your investment portfolio so that you can have the life that you want to live. I think it's really important to remember as you're making this transition into retirement what the most important thing is. And the most important thing is cash flow. Right? We're not in accumulation mode anymore. We're not trying, it's not about the highest rate of return. It's about how can we live comfortably? How can we have the lifestyle that we want? How can we spend our time with the people that are important to us and not have to worry about running out of money and not being worried, so fearful that when, volatility hits, that you're not able to sleep at night because there's a lot riding on this and you just don't want to make a mistake. So a few common concerns people have as they're trying to understand if they're going to be okay are as follows, or at least this is what I hear from a lot of people. Number 1, will equity returns be as high going forward as they have been in the past? Right? Because what we're trying to do is we have to make some assumptions about rates of return and how your money is going to work for you. So, in an environment like we're in today, where stocks by most people's estimates are fairly valued and somewhat expensive, can we expect the market to return the same type of, give us the same type of returns going forward on stocks as we have in the past? And then the second part to that question is, of course, given the current interest rate environment, how will allocating money to bonds impact your asset allocation decision? The bond environment's pretty tough right now. Last time I looked yesterday at the 10-year Treasury bond yield was less than 1%. I think it was like about 0.7%. And so obviously the reason that most people hold bonds in their portfolio is to reduce volatility in the bad times and also to provide some income for the portfolio. But a lot of these strategies we're going to talk about are based on how asset classes have performed in the past, and that's the data that they use to inform the decision. So as we look through these different seven different portfolio retirement income strategies, you have to understand that the research is done based on past performance of asset classes. So we need to be thinking about how they're going to be going forward. And then the other question that people are asking is, with interest rates so low, is this the right time to consider annuitizing a portion of my retirement investments for guaranteed income? So one thing that people consider when they get into retirement is using an annuity for guaranteed cash flow. But as many of you know, annuities, insurance companies, they're essentially buying bonds, and they use treasury bonds for a very stable portion of their bond portfolios. And then, of course, they have corporate bonds. And in many cases, if you're thinking about buying an annuity, you can do some research to understand what the financial strength of the insurance company is. And oftentimes when they're doing those analysis of the financial strength of the company, they're looking at how diversified the company is, but they're also looking at the underlying holdings that the company has. How secure, how confident are they in those bond positions that the insurance companies are buying. Okay, so here are the 7 strategies that we're going to discuss, and then at the end, I'll share with you my favorite combination. And I think it's important to recognize it doesn't have to be all or nothing. In fact, you will hear in some of these different strategies, there's kind of a mix and match. The bottom line is everybody's trying to figure out the best way to get cash flow. So here are the 7. Number 1, the 4% rule. Number 2, buckets. Number 3, dynamic spending. We'll look at two different dynamic spending strategies. The first one is the Guyton-Klinger white paper, and then we'll also look at the dynamic spending, that the paper that Vanguard did. And then we're going to look at the RMD method. We're going to look at a flooring concept, and then the idea of never touching the principal. So those are the 7 different strategies that we're going to review in today's podcast. We're going to start way back at the beginning. The research on the topic of how much can you withdraw from an investment portfolio started with William Bengen, who developed what we now call the 4% rule, which was originally created in the late 1990s. The way it works is pretty simple. At the time of retirement, you calculate 4% of your portfolio, and that becomes the first year withdrawal. And then you increase that initial dollar amount every year for inflation. It's pretty simple. So if you had $1 million, $1 million, you would take, and you're pulling the plug, you're ready to retire, you're going to say, okay, I have 4% of $1 million is going to give you $40,000 that first year. And then every year you're going to increase your withdrawals for inflation. William Bengen's research was originally done in the 1990s. He was looking at a 30-year retirement, 30 years of being retired. And he wanted to know, what was the withdrawal rate that you could take out of the portfolio and have the least likelihood of depleting the resources down to zero. He subsequently updated his research where he included some additional asset classes, and he later concluded that the 4% withdrawal rule, when you include these different asset allocations in the investment strategy, could be as high as 4.5%, but everybody remembers the 4% rule. And another way that people sometimes refer to this is the dollar plus inflation. So you figure out what the dollar amount is based on this 4% rule, and then every year you increase that dollar amount for inflation. So in the show notes, again, I'm going to include a couple of different research articles on this, some of which were written by William Bengen himself. So if you are interested in looking at why a 4% withdrawal rule may be oftentimes called the safe withdrawal rate, may be a strategy that you want to consider, we'll include that in the show notes.